Gold has become the trending topic recently. You may see your aunts and even that one particular family friend who tends to not fancy investments partake in this global craze. Gold booths pop up in malls, social media feeds flood with recommendations to buy gold, and now you're in a dilemma to either join the frenzy or risk feeling left out. In 2025, the gold rally was ignited by a global rate cut cycle. During such a cycle, short-term yields, or simply the rate of return for short-term government bonds, are cut down, forcing investors to seek better performing assets. In 2026, the narrative shifted. Investors now turn to gold not because of rate cuts, but because of tensions in the Middle East. In the future, a different form of uncertainty may once again drive gold prices higher. But why are people seeking gold? You may hear it described as a safe haven asset, an asset that protects investors during times of market turbulence, economic uncertainty, geopolitical crises, or financial panic. And here's another question. Why do people consider gold as a safe haven asset? Well, we first will need to take a time machine and see how it first started out. Gold's story as a store of value begins in the ancient world. The Egyptians, Mesopotamians, and Chinese all independently recognized gold as precious. It wasn't just decorative, it was chosen for very practical reasons. 1. It doesn't rust, corrode, or tarnish. 2. It's rare but not impossibly scarce. 3. It's divisible and malleable. And 4. It looks identical across cultures. By around 560 BCE, the Lydians, modern-day Turkey, minted the first official gold coins, and the concept of gold as standardized money spread rapidly. Skipping forward to ancient Rome, whose economy was deeply tied to gold. The aureus coin served as the backbone of imperial finance. When Rome debased its currency, mixing silver with copper, inflation followed, the first recorded demonstration that diluting money destroys value while gold holds it. On the other hand, medieval kingdoms stored wealth in gold treasuries, and the Catholic Church accumulated enormous gold reserves, reinforcing the metal's association with permanence and power. Then, we arrive at the gold standard era, 1870s to 1971. This is perhaps the most pivotal chapter in gold's modern history. This era is known to be divided into 4 important chapters, the first being the classical gold standard, 1871 to 1914. Here, major economies pegged their currencies directly to gold. A British pound or US dollar represented a specific, guaranteed weight of gold. This created remarkable monetary stability and enabled global trade. Then, the World War I disruption happened. Countries abandoned the gold standard to print money and finance the war, causing inflation, and gold's value became even more apparent by contrast. As gold can't be printed, gold holds value when currencies weaken. Bretton Woods System, 1944. After World War II, the Allied nations created a new order where the US dollar was pegged to gold at $35 per ounce, and all other currencies were pegged to the dollar. Gold was literally the foundation of the entire global monetary system. Then, finally, the Nixon shock happened, 1971. President Richard Nixon unilaterally ended dollar-to-gold convertibility, ending Bretton Woods. Gold was freed to trade at market prices. It subsequently skyrocketed, from $35 per ounce in 1971 to over $800 per ounce by 1980, validating gold's intrinsic value independent of any government's promise. Now, we've gone through the history, but history alone doesn't explain why you, sitting here in 2026 or later, should care about gold. Let's break down the actual mechanics of why gold earns the safe haven title. The first reason is inflation. And no, we're not going to throw boring economics jargon at you. Think of it this way. Imagine you had $10,000 sitting in cash under your mattress in 2010. Today, that same pile of cash buys you noticeably less than it did back then. That's inflation eating away at your money's purchasing power. Now, here's the thing about gold. You can't print it. You can't just decide to make more of it overnight. Global gold mining only adds about 1.5 to 2% to the total supply each year. So, when governments and central banks do print more money, like they did aggressively during COVID-19, the value of each dollar gets diluted. But gold? Gold doesn't get diluted. Its scarcity is baked into the earth itself. In fact, here's a fun way to think about it. A Roman soldier roughly 2,000 years ago was paid 1 gold aureus per day, enough to buy a decent tunic. That same weight of gold today, it buys you a pretty solid outfit. 2,000 years later, gold's purchasing power is essentially intact. Can you say the same about any paper currency in history? Spoiler, no. The second reason is something called counterparty risk, and this one is huge. When you buy a stock, you're trusting that the company won't go bankrupt. When you put money in a bank, you're trusting the bank won't collapse. When you hold a government bond, you're trusting the government won't default. Every single financial asset you hold depends on someone else keeping their promise. Gold has none of that. If you hold physical gold, there is no company, no bank, no government standing between you and your asset. It simply is what it is. This is exactly why, during the 2008 global financial crisis, when massive banks like Lehman Brothers were collapsing, investors didn't just want something that performed well, they wanted something that couldn't disappear. Gold fit that description perfectly. Here's the third reason, and perhaps the most practical one for everyday investors. Gold tends to move in the opposite direction of the stock market during crises. When equity markets panic and sell off, gold rallies. When confidence returns and stocks boom, gold often cools down. This is what investors call a low or negative correlation to equities. Let's put some numbers to it. During the 2008 financial crisis, the S&P 500, America's benchmark stock index, fell by roughly 57%. Gold over that same period actually rose by around 25%. During the COVID crash in early 2020, when global markets were in freefall, gold hit an all-time high of over $2,000 per ounce just months later. This is why financial advisors often recommend holding some gold in a portfolio, not because it always outperforms, but because when everything else is bleeding, gold tends to hold the line. It's the financial equivalent of a seatbelt. You don't wear it because you plan to crash. You wear it because crashes are unpredictable. And if you're still not convinced, consider this. The world's most powerful financial institutions are also betting on gold. Central banks, including those of the United States, Germany, China, and India, hold thousands of tons of gold as part of their official reserves. These aren't retail investors making emotional decisions. These are institutions with entire research divisions, and they choose to hold gold. In fact, central banks globally have been net buyers of gold every single year since 2010. When the smartest money in the room is stacking gold, that tells you something. So, to summarize the mechanics, gold protects you from inflation. It carries no counterparty risk. It moves against the market when you need it most, and it's backed by the silent confidence of governments worldwide. That's not just history. That's a very deliberate, very rational choice millions of investors make every single day. Now, with all of that in mind, where does gold go from here? In the short term, gold's rally engine would be very dependent on the peace developments between the US and Iran, as well as the profit-taking decisions made by investors. But regardless of how the tension unfolds, gold's belief system has survived every empire, every fiat currency collapse, and every financial innovation for 5,000 years. So, what do you think? Do you still think that gold is an attractive buy amid the recent highs, or would you wait until it has corrected further? Comment your thoughts down below. Don't forget to like, subscribe, and turn on your notification bell, because we will be uploading more financial insights